We continue to feel like 99. And it's so funny if you kind of compare, if you look at multiples and earnings and everything, we're kind of where we were in October, November of 99.
You just heard him. One of the most respected macro investors alive just said the market feels exactly like 1999, a full year before the dot-com bubble actually peaked. And here's the strange part. He told CNBC he's still buying. This comes just 3 days after another legendary investor made the exact opposite bet, and the stock he shorted crashed 11% in a single session. Today we find out who's actually right, why they fundamentally disagree, and what it means for your money. Something big is shifting in the market right now, and most people are only seeing isolated pieces of it. 4 things are happening at the exact same time. Michael Burry just disclosed a massive short position against Micron, one of this year's biggest winners. Paul Tudor Jones looked at that same setup and said the AI bull market still has another year or 2 left to run. Big tech is now on track to spend over $770 billion on AI infrastructure this year alone. And semiconductor stocks now make up nearly 20% of the entire S&P 500, the highest concentration any single sector has seen in decades. These 4 things are connected, and by the end of this video, you'll understand exactly how. Let's start with Burry. On July 1st, Michael Burry disclosed on his Substack that he shorted Micron at $1,051.87 a share. That number matters because Micron had already climbed nearly 700% over the past year and 241% in 2026 alone. Burry framed the trade as a bet against fear of missing out, the greater fool theory and public commitment bias. In plain English, he's betting that people are buying because everyone else is buying, not because the fundamentals actually justify the price. Days after his post, Micron dropped 11% in a single session, wiping out roughly $138 billion in value. Intel and AMD fell alongside it, down 9% and 7%. This isn't a one-time comment from Burry. He spent months building this case, comparing the recent run in the Philadelphia Semiconductor Index to the exact run-up that happened right before the March 2000 tech collapse. He's watched that index, which tracks NVIDIA, Broadcom, Intel, Micron, and TSMC, climb at a pace he says mirrors exactly what happened right before that crash. But here's where it gets interesting. Paul Tudor Jones looked at that same data and reached a completely different conclusion. In a CNBC interview, he said he'd recently bought more AI stocks, comparing this moment to the early days of Microsoft's PC in the 1980s and the commercialization of the internet in 1995, both of which kicked off productivity booms that lasted 4 to 5 years. He said we're roughly 50 to 60% through a cycle like that, with another year or 2 left to run. When the interviewer reminded him he'd made this same call a year earlier, calling it the fall of '99, Jones didn't back away from it. He said plainly that it still feels like 99, and if you compare current multiples and earnings, we're sitting almost exactly where the market was in October and November of that year. So you have 2 of the sharpest investors alive looking at the exact same data. One is shorting, one is buying more. But notice what they actually agree on beneath the disagreement. Both of them think this ends badly eventually. Jones said that if the market rises another 40% from here, its value relative to the size of the economy could reach 300 to 350%, and he predicted what he called breathtaking corrections once that unwind finally comes. So the disagreement between Burry and Jones isn't really about whether this is stretched. It's about timing and about how much money is left to be made before the clock runs out. Here's why this matters so much more than a normal sector wobble would. Semiconductor stocks currently make up close to 20% of the entire S&P 500, up from roughly 8% just 5 years ago. Compare that to the rest of the market, which has actually been shrinking as a share of the index over that same stretch. Semiconductors have essentially become a load-bearing wall holding up your retirement account, whether you've noticed it or not. So when chip stocks stumble, the whole index catches a cold, because this isn't a small, isolated corner of the market anymore. That's exactly what played out this week. The sell-off wasn't broad across the whole market. Stocks like Axon and Rocket Lab actually rallied while chip stocks sank, which tells you this wasn't blanket panic. It was concentrated fear in one specific sector. But because that sector now carries so much weight inside the index, the damage still rippled out everywhere. And it didn't stay contained to the US either. The selling jumped overnight to Asia, dragging down Samsung and SK Hynix as the fears spread through the entire global chip supply chain. Now here's something most people don't understand, and it's a big part of why this week's drop felt so much more violent than it should have. Leveraged ETFs like SOXL are built to triple the daily move of semiconductor stocks. To do that, they have to reset their exposure every single day. When the market falls, these funds are forced to sell into the drop just to stay balanced, which pushes prices lower, which then forces the next fund in line to sell too. Picture a car that gets heavier every time it brakes. The harder it tries to slow down, the harder the next stop becomes. It's not a conspiracy, it's just math. But it means an ordinary pullback in the underlying stocks can look and feel like a full-blown crash in these leveraged products because the selling feeds on itself. That's exactly why SOXL fell far harder over the past month than the actual semiconductor index it was supposed to track. Zoom out even further, and the valuation picture backs up Burry's concern more than most headlines are giving credit for. The Shiller-Cape ratio, which measures how expensive the market is relative to long-term earnings, is sitting at 41.64 right now. In the last 70 years, that level has only been reached once before, right at the peak of the dot-com bubble in 2000 when it touched roughly 44. We are now sitting just a few points below that exact historical line. Historically, whenever this ratio has climbed this high, the following 10 years of stock market returns have averaged close to zero. That doesn't mean a crash is coming next week. Valuations can stay stretched for a long time before anything actually breaks. But it's the same signal Burry keeps pointing back to. And underneath all of this sits the spending fueling the entire trade in the first place. Alphabet, Amazon, Meta, Microsoft, and Oracle are now on track to spend more than $770 billion combined on AI infrastructure this year alone. That number is the engine behind every chip stock's rally. Chip companies rise because big tech is spending heavily on AI. Equipment makers rise because chip companies are expanding capacity to keep up. And investors treat every new spending announcement as further proof the boom will keep compounding on itself. Burry's argument at its core is that almost nobody is asking the one question that actually matters. What happens if that spending ever slows down, even slightly, in a sector that now makes up a fifth of the entire market? This is only the second time in Burry's career that he's called something the final stage of a bubble. The first time was housing back in 2007 and 2008, years before that crash actually hit. But he was right. Now he's making the same kind of call about AI. 2 out of 2 so far. Whether this becomes his third correct call, or the one time he's early and simply wrong, is the exact question Wall Street is quietly arguing about right now. Jones isn't dismissing that risk either. He's just betting the timing works in his favor. He pointed specifically to the upcoming election and the arrival of Kevin Warsh as the new Fed chairman, arguing the Fed may actually be constrained from cutting rates the way markets want, similar to how fears around Y2K held the Fed back in 1999. In his view, that kind of constraint is oddly bullish in the short run because it keeps the same conditions in place that powered the market higher back then. So where does this leave you? I'm not shorting anything, and I'm not telling you to either. But here's the question I keep coming back to. If the stocks you're holding dropped 30% tomorrow, would you be comfortable holding through it? If the answer is no, that tells you something real about how much risk you're actually carrying right now, whether you've admitted it to yourself or not. The spending keeps climbing. The concentration in one sector keeps growing, and even the 2 smartest people in the room don't agree on when this ends. Only that eventually it does. Let me know in the comments. Are you with Burry, bracing for impact, or with Jones, riding the wave while the clock ticks down? Thank you for watching. Until next time, take care, and I'll see you in the next one.